Hello everybody, welcome to the start of the winter semester. We're starting off with this course with Chapter 9, which of course this is the second half, so the textbook starts with Chapter 9. And Chapter 9 is Property, Plant, and Equipment, so PPE, and Intangibles. So the first thing we look at is Property, Plant, and Equipment. So I'm going to try to do this for every chapter. Just going to do a brief run through because I know, like I said, there's a lot of reading. So I'm just going to kind of highlight some of the important things that I want to make sure you don't miss. So I'll be doing like a brief chapter summary, and it's more so a summary. I probably won't spend a lot of time explaining stuff, more so than pointing out things that I want to make sure you don't miss in your reading. I suggest you read the chapter. Read the PowerPoints, then I will read the stuff that's posted there for the unit, and then I'll be posting separately for each unit then the assigned questions and their solutions. And when I do that, I'll do some separate videos. I don't like to do one big video because I find not everyone has the a big amount of time to sit down and do it all at once. So I'll post a chapter summary, and then I'll post videos of some of the assigned questions. I'll try to touch on one of each type of question so that if you're having any issues, you can take a look at the videos. If throughout the chapter or throughout the working through the exercises, if you have any questions on exercises that I haven't done a video for, then just pop it into the discussion area. I like when you guys put it in the discussions because one, I'm on here every day, but I don't check at night. So if you're working on something in the evening, which I know a lot of you are, another student can possibly try to help you out. So I do encourage that. If someone asks a question and you know the answer, go right ahead. The next day when I take a look, if I see something and if the answer is correct that you were given, I probably won't do anything. But if I see that it was, I could add some more information, I'll still go ahead and do that. So answer each other's questions, but also if you're asking a question and I answer you, it's much easier if it's done in the discussion area because then anyone else can benefit. If they have the same question, they can look and see the answer there. And if you want any other questions like videoed, then just pop it in there too, and I'll do my best to get another video up for you. Okay, so starting off, Chapter 9. In the very first section, there's a couple of things here that are important. What are property, plant, and equipment, PPE? What sets it aside from other stuff? And one is that they're used in business operations to generate revenue. So such things as inventory and stuff that's held for resale. That's not property, plant, and equipment. These are things that are used in the business, and they help that business generate its revenue. And two is that they're longer term. They provide benefits for longer than one accounting period. And then there's three issues that we're going to take a look at when it comes to PPE. One is calculating the initial cost and any subsequent costs that come up for PPE. Then we have to learn how we're going to allocate those costs over the different periods. So how long is this property, plant, and equipment going to be in use? And then we allocate the cost over that time period. That way we're matching the expense with the revenue that it's generating. And then how to record the disposal. So these two things here are of note in the first section. Then on page 608, we move ahead to look at the cost. So PPE are recorded at cost. So that includes all normal and anything that's reasonable to get it in a situation that it's ready to use. So it gives some examples here of things that are included in the cost. Then it talks about betterments. So that's something that happens typically later. It's a cost that is going to it probably extend the life of the PPE, or it's going to make it function better. It's typically a larger expenditure as opposed to repairs and maintenance, which is just something to keep it in working order. Next, the textbook goes through the different types of PPE. So land, for example. So this is important to look at. So it looks at land and what the costs would include for land. If the land was purchased with a building on it, then it tells you what you can, what costs you would include. Land improvements are separate. And again, so just take a look at each one of these different categories, what they are and what costs can be included. So land improvements, buildings, and there's a difference between acquired buildings and constructed buildings, leasehold improvements, machinery and equipment, and then what to do if there's a lump sum purchase. If there's a lump sum, it walks you through an example of how to allocate the costs, and this is purely mathematical. If you paid, over here we're saying they paid $630,000 in cash, but how much goes allocated to each of these three different categories? You base it on the appraised value of each one of them. So the land is at $210, land improvements are at $70, buildings $420. Then there's the total of $700. So what portion of this, the total, is the land? $210,000 is 30% of $700. Therefore, land, 30% of the cost that of the purchase of $630 is going to be allocated to land. So it does walk you through an example there of that. So that's important to take a look at. Then we move on to depreciation. So that's the process of allocating the cost of the asset over the different periods of its useful life. Let me see. So here, I'm going to scroll on down to, there we go. So things that we take into consideration then when we're looking at depreciation are the cost, the original cost of the asset, the residual value. So in the end, if we're going to sell the asset, how much are we going to obtain for that? And the useful life of the asset. We look at three different depreciation methods. So straight line depreciation, that's the one that's most commonly used. Units of production and declining balance, or double declining balance depreciation. So those three are then explained here. Straight line depreciation is the same amount over the useful life. I said work through the example. Units of production, you're taking the cost less residual value, dividing it by the total units of that the machine is expected to produce, and that gets you a depreciation amount per unit, and then you multiply that depreciation amount by the units that are produced each year. And we keep going. The declining balance, and here it does indicate it's 2 divided by the estimated useful life. So if the estimated useful life, for example, is 5 years, it's 2 divided by 5. If it's 10 years, it's 2 divided by 10. And then we calculate annual depreciation expense. It's a declining balance rate, so it's multiplied by the book value at the beginning of the period. So in period 1, it would be the book value is the cost, and you multiply it by this rate. In period 2, you would take the book value less the accumulated depreciation, so whatever the depreciation was in year 1, and then you would multiply that balance by the rate. And in year 2, you would continue on, the book value less any accumulated depreciation multiplied by the rate. And then, like I said, work through those examples. Then we look at partial year depreciation. So you can do it by the nearest whole month or half year. Nearest whole month, you would look at when in the month it was purchased or sold, for example. Typically, if it's more than half a month that's included, then you count for the whole month. If it's less than half a month, then you don't include that month. Or if it's half year, then if it's purchased or sold in that year, you just automatically take a half year's depreciation. We then go on to look at what to do if we need to revise a depreciation rate. When we do stuff like this, we do it on a go-forward basis. We don't go back and change what's already happened. We change what's going to happen in the future. So there could be a change in what they estimate the residual value or the estimated useful life. I'm not going to get into that right here, but they do explain it in the book, and I will likely do a question on it in the when I do separate videos for the questions. I think that's it for... Sorry, I'm looking at my textbook on my desk while I'm trying to match it up with what's on my screen. Okay, here. Impairment. So impairment is if the book value... Let me see if I can see... Impairment is if the book value, you're comparing it to, what's the word I'm looking for? The amount that you would, the market value, for example. If it's less, if the book value that you have is, so if the book value that you have, you compare it, and the word I was trying to come up with was recoverable amount. So you compare it to the recoverable amount of that asset. If the amount that you have as the book value is greater than what the recoverable amount is, then you're going to have an impairment loss, and that's going to be the amount of the difference between those two values. And again, they do briefly touch on an example here. This next section talks about disposals of PPE. Now there's three different situations. You could discard the PPE. That's when you get rid of it, but it has no market value. There could be, you could sell it, where you'll get something for it. You'll get cash or something for your asset, or you can exchange it, where you'll have a trade-in value. So it walks through each of those examples. They're all handled fairly similarly, just with a minor difference. So again, I'll look at we'll do a question like that in a separate video. And then finally, the last section is on intangible assets. So they are things that are, they don't have physical substance. So as the book describes here, they are rights, privileges, and competitive advantages that are separately identifiable but have no physical substance and are non-monetary. Should really have a second coffee before I do these in the morning. Okay, so when we look at intangibles, they're all accounted for pretty much the same way, but there's patents, and you do amortize. Oh, that's what they point out here. Now, this doesn't necessarily... the book is telling us that depreciation is for plant and equipment, and amortization is for intangibles. It's essentially the same thing, but you will find in practice those two words get thrown around, and they pretty much mean the same thing. And they're so pretty much here, they're all typically handled very similar, but a patent gives you the legally protected exclusive right of an invention here, and it's for 20 years. A copyright is for the life of the creator plus 50 years. Mineral resources, so drilling rights, different various ones here, and that is the timeline for those is usually indicated in the question because they're all different. And then there's trademarks and leaseholds. So they describe what each of the intangibles are, but they're all, like I said, all handled pretty much the same. Okay, so that's it for the summary. I said I go fairly quickly, just pointing out some things because the platform that I use for videos, we're limited to 15 minutes for each, so we're at our 15-minute mark. So I'm going to return with some sample questions next.